Hello and good day, everyone. Today we are going to look at the three main components of statement of financial position. These components include assets, liabilities, and equities. Now, let's start with the first one, assets. Now, what are assets? Basically, asset is defined as resources controlled by the company that are expected to provide future economic benefits. In simple terms, assets are what the company owns. These are things that the company has control over and hopes will bring money or benefit to the company in the future. Assets can be divided into two main types based on how quickly or easily they can be turned or converted into cash or used up. First, there are non-current assets. These are assets that the company intends to use for a long time and they are not easily convertible to cash. Think of the big important things a business needs to operate over many years. For examples like building, the land the building sits on, the machinery used in production, equipment, and company motor vehicles. These are things you don't plan to sell quickly. The second part is the current assets. These are assets that are intended for short-term usage and are considered easily convertible to cash. In other words, they are very liquid. The items under current assets are very liquid. These are the things a company uses up or turns into cash relatively quickly, usually within a year. Examples provided are cash at hand, basically referring to money, physical money, cash at bank, money in the company's bank account, inventories, basically referring to the goods the company intends to sell, and also the account receivables, basically the money that customers owe to the company. So, in short, assets are everything the company owns, split into long term and short term items. Now, let's move on to the second component, liabilities. While assets are what the company owns, liabilities are the opposite. Liabilities refer to any debts or obligations that are owed by the company. It's essentially what the company owes to others, to the suppliers, to the creditors, to the banks, etc. etc. Just like assets, liabilities are also categorized into two types. First, we have non-current liabilities. These are debts or obligations that are of a long term in nature. This means that the company doesn't expect to pay them off anytime soon, typically beyond a year. Basically means all these obligations by the company is to be paid more than 1 year, longer than a year. Example include long-term loans, bond payables. Bond payables refers to the money owed to people who bought the company's bonds. And then you have leases, okay, referring to the long-term rental agreements, and deferred tax liabilities, okay, which refers to the taxes that will be paid later. Okay, and then you have current liabilities. These are debts or obligations that are of a short-term nature. The company expects to pay these off relatively very soon, usually within a year. For example, given account payables. Account payable refers to the money the company owes to its suppliers. Another example is short-term debt. Okay, and then taxes payable, and then you have dividend payable, basically dividends owed to shareholders, uh, any accrued expenses. Okay, basically means expenses incurred but not yet paid. So liabilities represent all the money and obligations that the company owes to others, again split into long term and also short term. Now, finally, we come into the third component, equities. Now, equities refers to the owner's stake or shareholder stake in the company. It's essentially the owner's part or net worth in the business. Equities basically means what is left to the owners after paying off all the debts. Imagine if the company sold everything it owned, all of its assets, and used that money to pay off everything it owed, all of its liabilities. Whatever money is left over belongs to the owners, and that is what we refer or we regard as equity. Normally, the items that make up the equity section consist of things like share capital, basically the money raised from issuing shares, retained earnings, the profit that the company has kept and reinvested into the business instead of paying out as dividends, and also other reserves. So to summarize, the statement of financial position has three core parts. Assets basically refers to what the company owns. Liabilities refers to what the company owes. And the equities basically what belongs to the owners after all the debts are being paid. These three components always balance out following a fundamental accounting equation. Assets equals liability plus equities, and it makes sense, right? What you own must equal what you owe plus what's left for the owners. These statements give a crucial picture of a company's financial health at a specific moment in time. And that concludes the presentation.